Welcome back to AAA Academy. My name is Delia. I'm a co-founder of AAA, an over-collateralized decentralized lending protocol. This series of lessons will cover decentralized exchanges, which represents a key segment of the entire DeFi ecosystem. In traditional finance, financial exchanges are present all over the world. All different continents or countries have those centralized entities that are creating financial value by bringing together all types of traders and brokers and participants. Whenever you perform a trade, whenever you want to actually exchange financial value, paying in your home currency or another currency, there is likely an exchange involved in your purchase. So how do financial exchanges actually function? What is their architecture? What are their components? So let's break them down. So financial exchange typically has a trade matching engine. Trade matching means that if you have two participants, you want them to find a matching trade, something that they agree on in terms of quantity of assets and in terms of price of assets. So once you found few trades that are matchable, you forward them to the trade settlement engine, and this is the place where the assets actually get swapped. So those are the traditionally main components. If we go a little bit deeper, the trade matching component also contains something like a price finding mechanism. So here you have Alice and Bob, and they each have a coin in the trade settlement layer. This is their current possession. Alice has a black coin and Bob has a white coin, and it seems like they want to trade those coins. So Alice will put in an order meaning she would like to execute an exchange. She would like to exchange her black coins against the white coins. It so happens in this example that Bob does the same, but in reverse. So he has a white coin and he would like to purchase black coin. Here you can see that the exchange values are equal. So they both agree to exchange the coins, orders are matched through the trade matching engine and forwarded to the trade settlement layer. Once the trades settle, the actual assets become swapped in both accounts. So let's go into a bit more details on the trade matching functions through an order book example. So an order book is a very traditional way of aggregating orders. It is a real-time list of buy and sell orders for a specific security or tokens arranged by price levels. So, for example, on the left-hand side, Alice is putting a significant buy order of 21.23 tokens, and the price that she's willing to purchase this token is at 418.40. The right-hand side at the bottom, we have Bob, who is willing to sell a few of those coins. It's a bit less. It's only a quantity of 9.5, but he's willing to sell it at a price of 418.41. So those two orders are currently not matching. They cannot be executed because there is no agreement between the bids and an ask, or between the selling and the buying orders, of what should be the price at which we actually perform a trade. The difference between those two prices we basically call the spread. So in an order book, a term that you'll also often encounter is LOB, or limit order book. The limit here comes when the seller and the buyer specifies the price limit they're willing to purchase or sell an asset. Now, if you look a little bit deeper into the order book, you can see on the right-hand side that there are quantities of, but those quantities of selling are very small compared with the quantity close to the spread, which is 9.5. A cumulative quantity times the price is referred to as the order book depth. The deeper an order book is, the better, because the more liquid the market is, meaning the more money this market can provide to you as a trader. Typically, we are looking for rather liquid markets because those are efficient and you pay less fees. There are two order book models in a blockchain that we can think of. There might be others, but let's just discuss here those two basic components. So you have the server order book and you have the on-chain model. If you operate an order book on the server side, you have a fast matching, which is great because speed matters in financial trading. There are also no fees for canceled orders, which is also great because you can just put in orders. You can cancel them at any point in time and you're not incurring any fees. Now, the drawback, however, is that there is no clear censorship resistance, and you can also not prevent the exchange from actually front-running your orders. So if you put in an order and the server decides to front-run you, they put an order in front of your order. First, you don't see it because there is no transparency, and the second, they might financially profit from your order, which is executed at a later stage. On the other side, the on-chain model has a quite few interesting characteristics. So first of all, we have a censorship resistance. If the smart contract is written in a way that nobody else can censor the protocol, there are no administrative keys, and therefore we have a very strong censorship resilience feature. Because the blockchain is running possibly much more reliably than a server, it's also relatively robust. Obviously, for that, you have higher fees. There are also few drawbacks, such as slow matching, depending on how fast or slow the confirmation latency on your blockchain is. For on-chain transactions, you must pay a fee even if you just want to cancel your order. By creating an order and then canceling it, you'll pay twice the transaction fee, so that's quite significant. They're also not immune from front-running. A miner or a blockchain trader could front-run your trades, and this is a major issue in a decentralized exchange. So now I would like to draw your attention to EtherDelta, which was one of the pioneers in this space. This was one of the first, maybe the first, but let's say one of the first decentralized exchanges with an on-chain model. There was still a server that kind of helped the exchange to coordinate trades, but in order to participate in this exchange, the first thing you have to do is deposit some amount at the very beginning. You couldn't actually start trading right away from your wallet, as you may now you're used with Uniswap or similar AMMs that we'll discuss later. But basically here, you're really required to deposit some coins into a contract at the very beginning. You can later trade, and then finally you can withdraw those coins again. So the initial step is to deposit the asset into a contract, and only once they're deposited, you can create a buy or a sell order where you specify the amount and the price. Similarly, you have the visualization of an order book as we discussed in the prior example. It is slightly different, but in essence, it explains the same. In the middle, you have the price. There are some candle bar charts, and on the right-hand side, you can also see the last executed trades. They are very helpful too. Overall, EtherDelta was quite a successful exchange. It was one of the most actively used exchanges, but still, it didn't get the same popularity, I would say, as for example, Binance or centralized exchanges in general. So what are the lessons learned? What are the advantages of limit order books and what are the disadvantages? Some of the advantages, certainly, were the time that there was no KYC AML requirements. When those exchanges existed in the very early stages, because it was a very new technology and no regulators had any clear vision on how they should regulate it, those KYC were not required. To my understanding, there weren't known fees paid to exchange. So the market makers who are actually filing the order book, putting in orders and taking out orders to serve the market, they're gaining from the exchange prices, but there are no fees paid directly to exchange. Another advantage of the limit order book is that there is at least no direct impairment loss if you put in an order with a certain limit, because you're not a liquidity provider, you're not a market maker, so you're just trying to execute a particular trade. The disadvantages of this model is that there were fees, like an excessive amount of fees for every deposit, withdrawal, trade creation, cancellation. And this is unfortunately affecting the transactions on the blockchain quite significantly. So that's certainly a problem and something that needs to be addressed somehow. The slow execution is not great either. It reduces competitiveness of those exchanges, so arbitrage will be slower if you want to synchronize the price with different other exchanges and centralized exchanges, which are much faster than such limit book order. Although they're called DEXs or decentralized exchanges, they may still not be fully decentralized. So this is something I would recommend you to be a bit careful about. If a project or a protocol claims to be decentralized, then there might be different definitions of what is decentralized or what particular components are decentralized. So please always be a critical mind of asking the right questions about what is decentralized and what does that mean. So we went over the trade matching in more details. And now let's go into the non-custodial trade settlement. So non-custodial means that you are in control of your assets. So you are the one that actually controls what is happening with your coins, and nobody else is supposed to be able to take away your funds. Why do we need DEXs? Why do we need decentralized exchanges? Imagine you have, for example, Alice. She's rich, she has a lot of coins, and she wants to provide her coins to other traders. And in that process, she would like to earn some fees. But she doesn't want to trust anyone. So she doesn't want to give control of her money to anyone. On the other hand, you have Bob, which is an intelligent trader, and he would like to buy the latest coins, and he struggles to find a trusted source. Once he provides some funds, he wants to make sure that the funds are actually being exchanged against something that he wanted to purchase. So the underlying idea of a DEX is that you have a price discovery and a trade matching engine all defined in a smart contract and the trade clearing. Naturally, the price discovery in the trade matching can happen in a limit order book, but as we'll see in the following sections, there are also so-called automated market makers, AMM, which basically operate in this way. And they have few advantages in terms of transaction creation cost, transaction canceling cost, etc. So just to give you a bit of an intuition of how important DEXs actually are, those are the daily volume of DEXs or decentralized exchanges for June-July 2023. And you can see that on average, the volume is around 1 billion. And the monthly volume grew significantly after mid-2020. A lot of centralized exchanges, especially in the crypto space, are prone to wash trading. So wash trading is the process where you create fake volume on an exchange in order to artificially increase the trade volume. On a decentralized exchange, you need to pay transaction fees. So the process of wash trading is much more expensive. And therefore, I believe that the numbers that we are seeing here for the daily and the monthly volume is likely more accurate than the accuracy of numbers reported by centralized exchanges. Thank you very much for listening to this first part of the lecture. I hope you liked it and looking forward to seeing you in the next part.